Hello, everyone. Welcome to Money Minutes. This is your host, Zak Gardezy. I'm the founder of Wealthstone, a private wealth management firm based out of Scottsdale, Arizona. I'm also a private wealth advisor and a certified financial planner. So here on Money Minutes, I share with you some of the latest market headlines and my outlook for what's ahead. So for this week's episode, we'll focus on really one of the most anticipated economic events of the year, which is the moment when the new Trump administration places sweeping tariffs that they've talked about on basically every single country around the world. And so on today's video, I'm going to answer two very common but important questions. Number one, how will these tariffs affect you? And number two, how will these tariffs affect the overall economy and my outlook on the stock market? So let's get right into it. So to answer the first question of how will this all impact you, I'd like to start by explaining what a tariff is, and then explaining what the Trump administration has just announced on April the 2nd. So to start things off, a tariff is a tax on imported goods. Now, any country out there is capable of placing a tariff on another country, sectors or industries or products from those countries, to be more specific as well if they would like to. Now, basically, I'll give you an example of where this could be useful and what countries are looking for when they consider placing tariffs. So a great example is to use Toyota. It's a commonly used example. Toyota we import a lot of Toyotas into the United States. They make excellent vehicles. They're well priced. There's a lot of demand here for Toyota vehicles in the United States. So a commonly quoted figure is about 1 million Toyota vehicles imported into the United States. Now, let's just think about the impacts of this. So just to put it in a vacuum, 1 million Japanese cars make their way into the United States. Now, that means 1 million less American cars are potentially sold in the American market. So then that affects American car companies. That affects the jobs that rely on those vehicle sales. That affects the local communities and certain geographies in the United States, like Detroit, that were reliant on vehicle manufacturing. And so this completely shifts elements of the economy negatively, to be precise, and then this benefits Japan and their auto industry and their employees and their GDP and economic growth as it relates to the auto sector. And so what countries try and do when they notice these types of imbalances, because let's be frank, we don't sell as many Ford or GM or American vehicles in Japan as they sell here in the United States. Now, one could say, that's not Japan's problem. Maybe we don't sell or make vehicles at a good enough prices that competes in Japanese markets. But the fact of the matter is, Japan places significant tariffs on American products that are imported into their country, right? And so, to that respect, the Trump administration is looking at this and going, look, there's clearly an imbalance here. It's negatively affecting our auto industry. And so what we're going to do is place a significant tariff on Japan and on the auto industry in general, so then that way we can give a boost to the American auto industry. Now, of course, the negative effect of that is you're going to have higher vehicle prices, because what Toyota will do is they're going to look at the market and say, hey, look, we have so much demand for our vehicles that if we raise prices a bit to either completely or partially offset the tariff that's being charged on us now, then maybe Americans will continue to buy our vehicles. And if so, then great. Americans just end up paying more for Toyota vehicles. Now, what the Trump administration is hoping will happen is a couple of things. That potentially the Toyota product is now so expensive that Americans will rather flock to American vehicles, thereby boosting the American auto industry. That's one potential situation. The other is that maybe Japan goes, you know what, this is going to seriously negatively impact our auto industry and overall economy. Let's go to the table with the Americans and try and figure out a new sort of trade deal with them to be a bit more fair. Now, this has happened in the past, and I'll talk about later some specific examples of tariffs and tariff threats and what have been the results of these. But that is the potential scenario that the Trump administration is looking for, which is to negotiate some sort of a new deal with Japan as it relates to not only just the auto industry, but the overall trade imbalance that we have with that country. And that's just one example. But as an investor, as a consumer, you can expect that in certain products and sectors, you will see price increases. But as I mentioned earlier, It is specific to products and sectors because there isn't a lot of wiggle room in some areas. For example, in technology, just to give you a very basic example, let's use Apple products versus Samsung products. If one of these products faces a significant tariff and has to increase their prices as a result, they both make excellent products. Of course, both have their very strong fan base that are so loyal that they may just end up paying the higher prices. But there are going to be a large subset of consumers who go, you know what? Maybe I'm not willing to pay an extra 25 or 10 or 50% for an iPad. Maybe I'll go with a Samsung tablet or vice versa. And so a lot of technology companies are going to feel the strain of this, and they may just end up eating the cost on their own. Maybe they'll lay off workers, which ends up resulting in higher unemployment, which then, of course, cascades into other significant negative economic events, not only in the United States, but potentially globally as well. And so just the simple tariff can have a mountain of effects, not only on the consumer, but also on the economy as well in the overall market. And so from a outlook perspective, what I think will happen is that, and we have historical evidence of this, is usually when significant tariffs are placed on other countries by the United States, we are such an important trading partner and we are such strong consumers here that other countries immediately start flocking to the table and saying, you know what, America, maybe we have made a mistake. Maybe we can be a bit more fair. Let's come up with some sort of a deal. Now, actually following through with those deals and actually complying with them 100%, that's a completely different story. There's a lot less confident evidence that those types of deals actually get followed through on. But nonetheless, the existence of these tariffs, I believe, will not be here for too long. But that is a topic that I'll talk about a little bit later in terms of the potential impacts on the economy. It really has a lot to do with the duration of the tariffs. But as a consumer, and as mentioned, in the short run, we could expect higher prices on certain products and certain services. But again, I do not expect it to be broad-based. I do not expect the price of everything to just go up tomorrow. And I did get asked this question previously by a client, which that was a great question, which is, are the price increases from tariffs a one-time hit, or are they sort of ongoing and compounding in a way like inflation is? Now, the actual initial price increases on certain products, they will be a one-time event. But then the cascading effects that I've talked about on other parts of the economy, that is something that will have reverberations for potentially many months or even years to come, depending on how long these strong tariffs are in place. And so hopefully that answers the question of how will this impact you. And as an investor, we really need to pay attention to the developments with these tariffs and many other countries around the world. Again, in my opinion, I think that we're going to start seeing all sorts of news headlines popping up about this country and that country trying to form a new deal with the United States. And hopefully they happen soon, because the longer these tariffs stay in place, the more dire the economic impact. So I'd like to spend a moment talking about the potential positive outcomes of tariffs and then the potential negative outcomes. And so some potential positive outcomes are a boost to domestic industries. So tariffs can protect domestic manufacturers from foreign competition, which then potentially leads to increased production and job creation within the country. There's also the negotiation leverage aspect of things. So as I mentioned in the previous segment, that, with tariffs, especially strong tariffs, this could push countries who are otherwise unwilling to compose new deals to sit at the table and avoid the serious negative impact that could be imposed on their country as a result of the tariffs. There's also the positive outcome of reduction of trade deficits. So by making those imported goods more expensive, these tariffs can encourage consumers to buy domestic products, which thereby, of course, reduces trade deficits. The encouragement of local investment is also another positive outcome. So, protectionist measures like this can incentivize businesses to invest more in local operations and infrastructure, which is a great boost. Revenue generation for the government is also talked about a lot. So tariffs generate additional revenue. They are taxes that can be utilized for public services and infrastructure projects. Now, whether the government uses the money generated for those measures, that's a whole different conversation. The development of emerging industries is another. So temporary protection which we have seen this before in other tariff situations, is by adding tariffs, you then give the domestic industry some time, some protection, we call it, in the short run, to either restructure itself, to make itself more competitive, or to maybe develop and come out with new and other types of products that make their industry stronger and better. Straightening of national security, that's a key aspect here. So certain industries that we have lost market share in are key for national security. And so by putting tariffs on other countries that have taken this market share from us, this could strengthen our national security in a way. Also, the promotion of fair trade practices. And so tariffs can be used to counteract unfair trade practices. And so that is something that's important and a good aspect of trade tariffs. You also have the stimulation of domestic innovation, as I talked about a little bit earlier, which is, when you have less foreign competition and you have more money being generated by domestic companies, it could be possible that they come out with better and newer and more exciting products that then make them more competitive globally. And then, of course, you have job preservation. This is something that's not talked about as much, but I think is extremely important, which is the fact that when you have job preservation, you have the fact that these employees maintain their wages locally. They maintain their local communities, their homes. They continue to prosper. They invest more in their communities. You also have the aspect of wealth generation. You maintain your jobs. Maybe you get promoted. You make more money. You invest more in the market. You invest more in private businesses. You start a side business, whatever it is. All of that wealth generation is really difficult to actually quantify. But if you go back to when China became a permanent trade partner of the United States, basically early 2000s and on, and we try and quantify the negative impact of wealth loss by jobs being shipped out overseas as a result of trying to, save some money on labor costs, it is in the trillions of dollars of wealth lost in the United States by jobs being lost. And so did we offset that by trillions of dollars in savings by using cheap wages internationally? That's debatable, but I have not seen serious research that tries to quantify the wealth loss in this country as a result of unfair trade practices and offshoring jobs. And so I want to transition into talking about the negative potential outcomes of trade tariffs because I believe that's also something important to discuss. And so some negative outcomes are increased consumer prices. We've discussed that already, which is, tariffs often lead to higher prices for imported goods. This is a burden for consumers, but we do need to be, of course, as I mentioned, more mindful of the specific sectors and industries and products that are affected by tariffs because some will be affected more than others. You also have retaliatory measures, so that is a huge unknown. How are other countries going to react to this? And so I'll talk about an example later, which talks about, we have put tariffs, especially broader based tariffs on countries in the past. And in one particular instance, the retaliatory measures were catastrophic. It's rare for that to happen, but it has happened before. So we have to pay very close attention to that. You also have the disruption of global supply chains. And so many industries rely on international supply chains. Tariffs can disrupt these. This can lead to all sorts of inefficiencies and increased costs for consumers. You also have the negative impact on GDP growth. So trade barriers, tariffs, these can all have negative effects on economic growth. We're already seeing major firms and economists come out with updated estimates, even from the Federal Reserve, talking about their expectations of less GDP growth as a result of some of these policies. You have the strain on international relations. We're seeing that play out very close to home with a strain with our Canadian relations, with Mexican relations, and then, of course, the EU. I mean, some of our allies are showing discontent with some of these trade practices, which then, in a way, also hurts our national security as well. You also have reduced export competitiveness. And so retaliatory tariffs, so let's say, okay, now we're placing these strong tariffs on Japan. Well, they place even stronger tariffs on us, making us even less competitive in their markets. So were we better off in that instance? And that's something to be seen. You also have job losses in export sectors. So there are many companies and businesses in the United States that rely on exporting to other countries. If these tariffs are going to affect them, these retaliatory tariffs, then you may have job losses in these sectors that rely a lot on exporting. You have inflationary pressures as well. So that is going to, of course, have a negative impact on the economy. You have limited product availability. So tariffs can reduce the variety of goods available to consumers. This is going to limit our choices to an extent. And then you also have potential violations of trade agreements. This kind of dives into more of the geopolitical, political science element of things, but you do have the potential risk of seriously harming not only just trade agreements, but also just overall alliances with other countries as they look to potentially consider other trade partners that we may not be allies with. A great example is, depending on how negatively impacted some countries are by our trade tariffs, some countries could turn to China and say, hey, look, what can you do to help our economy and become a better partner of ours? Now, that's a serious step in the other direction for any one of our allies. But again, this is the risk that you play when you threaten to harm and significantly harm the economies of some of even our allies. And so that's why I think it's important for us to talk about the positive and negative outcomes. And of course, you would hope that the administration has weighed the positives and the negatives and is continuing down this path because they have a plan in place. But as investors and as consumers, we need to know what are the potential ramifications either way. And so hopefully this helps you understand that. So next, I want to provide some examples of historical moments where the United States has placed significant trade tariffs on other countries and what were the impacts of them, because I think it's important to understand what's the historical context of this, mainly because the Trump administration points to historical context, but also as investors and as consumers, we want to understand, how has this played out in the past? You get media sources, whether it's on the left or the right, that share with you, okay, based on this outcome, everything is going to collapse. And then you've got other sources that say, what, we're about to become the wealthiest nation on the planet because of this one particular event. I think it's important to look at what's happened in the past. Although our modern world is completely different than it was 100 years ago, there are many elements of economics and finance that are still, of course, true today. So let's focus on a few of these examples. Number one, you've got the Smoot-Hawley Tariff threats event. And so this happened between 1929 and 1930. So the Smoot-Hawley Tariff Act of 1930, that eventually became a law. There was a 2-year period of negotiations and threats where the U.S. Congress debated sharply higher tariffs on countries. And so the bill itself proposed raising tariffs on over 20,000 imported goods, with average rates increasing from 38% to 59%. And here are some of the countries that were involved: Canada, France, Germany, UK, and Latin American nations. They were the biggest trade partners that were impacted. And then many Latin American countries, such as Argentina and Brazil, threatened retaliation if these tariffs were imposed. And so here's kind of what happened during that period. So there was a debate period, as I mentioned, from 1929 to the early parts of 1930. Several U.S. trading partners negotiated temporary tariff reductions or bilateral deals. And this was in an effort to avoid the full impacts of these tariffs. Such as an example is when Argentina negotiated a temporary agricultural export deal for wheat and beef during the debates to preserve access to the U.S. markets. But once the law was passed in June of 1930, serious global retaliation ensued. So Canada imposed tariffs on 16 U.S. goods, including agricultural products. U.S. exports fell 61% between 1929 and 1933, and then global trade volumes fell by approximately 25% between 1929 and 1932. And so the key here is that was a terrible outcome of using tariffs. And so it has happened before to where these sort of broad-based, very aggressive tariff strategies just blew up in our face. Now, another important aspect of this is that prior to the tariffs being implemented, there was a lot of negotiation happening, and there were many countries who tried to get their way out of these tariffs. Now, I believe if you're the Trump administration, you're hoping that happens again this time. And maybe this time, possibly before implementation, because let's face it, there was an announcement of tariffs. The actual implementation timeline and mechanism is really unclear at this point. Countries still have time to try and negotiate their way out of it. And if they can, great. Trump administration will chalk this up as a win. This will help them in the midterm elections, of course, in the next general election as well. The other nations will avoid potentially catastrophic negative impacts to their economies. And then we, the investors and consumers in the US, will avoid some or maybe a significant amount of price increases and negative effects to our economy here at home. So that's one example. Another example is when the Reagan administration, they placed semiconductor tariffs on Japan. And so here's what happened. In the mid 1980s, the US semiconductor industry accused Japan of dumping DRAM chips, which is dynamic random access memory chips, at below market prices globally. And then this blocked US chip makers, of course, as well, in their policies from accessing Japanese markets. So then the US trade deficit with Japan in goods, it was around 50 billion back in 1985, which then if you adjust it for inflation today, it's about 135 billion dollars. A lot of it was in electronics. Well, then in 1985 and 86, the Reagan administration, they imposed a 100% tariff on $300 million worth of Japanese electronics. This was TVs, computers, and video recorders. And then also the US filed unfair trade practice cases under Section 301 of the Trade Act of 1974. So what was the impact of this? Well, the negotiated result was in 1986, Japan signed the US-Japan Semiconductor Agreement. They agreed to stop dumping semiconductors in global markets. They opened Japanese markets to US semiconductor producers. They increased US market share in Japan, so it increased from 10% to 20% within 5 years. And then they also provided market transparency to the United States. And so this was a good thing for the US semiconductor industry, and it really helped reduce the trade deficit we had in that particular sector. But here's the downside. Japan did not fully comply with the deal. And then there was global competition from Korea, which then re-emerged. And so the benefit, though, as I mentioned in an earlier segment, is that it did bring about 5 years of breathing room for the U.S. semiconductor industry. This allowed the U.S. industries to get a bit more competitive, to, of course, survive for those extra years, as the Japanese behaviors prior to were really hurting the U.S. semiconductors. And so that's another key example. Another one is the Bush steel tariffs from 2002 to 2003. So in March of 2002, President George W. Bush imposed tariffs of up to 30% on steel imports from Europe, Asia, and South America under Section 201. The move was in response to years of declining U.S. steel production, mill closures, and job losses. And the U.S. steel industry had lost over 50,000 jobs between 1997 and 2001. And as mentioned earlier, the countries that were involved and were impacted by these tariffs were, of course, the entire European Union, Japan, South Korea, Brazil, Russia, and China. And here was the effects of these tariffs. So U.S. steel prices rose by 30 to 50% during the tariff period. U.S. steel production increased by 7%, and industry profitability improved. And then employment in the steel manufacturing industry stabilized temporarily. But there were retaliation threats. So the EU filed a WTO case against the United States, and then they threatened $2.2 billion in retaliatory tariffs targeting politically sensitive U.S. exports like Florida oranges, motorcycles, and textiles. So the outcome of this overall was the WTO, the World Trade Organization, they ruled against the U.S. in late 2003, and the tariffs were lifted after 20 months. So, but nonetheless, U.S. steel companies use this time to consolidate and to improve their businesses. And so that's another key example that we should focus on. I'll also talk about the U.S. chicken tax, which actually that started in 1964 and is still in effect today. So the background on this is in the early 1960s, European countries led by France and West Germany, they imposed tariffs on imported U.S. chicken, citing unfair subsidies. This led to what was called the Chicken War, which was a significant trade dispute. Now, in retaliation, President Lyndon Johnson opposed a 25% tariff on imported light trucks and commercial vans from Europe and Japan in 1964. Now, this was done under Section 301 of the Trade Expansion Act of 1962. So here's the effect of this. It's nearly eliminated small truck imports from Germany, specifically Volkswagen vans, and also, of course, small truck imports from Japan. This protected the U.S. truck manufacturers like Ford, GM, and Chrysler. And then the U.S. light truck market became one of the most profitable sectors domestically. And then the long-term results are, the tariff remains in place today, actually. It's one of the longest standing trade barriers in modern history, and it permanently tilted the light truck market in favor of U.S. automakers. Now, the downside is it really reduced U.S. consumer choices in terms of the light trucks we have available, and of course, higher prices in the trucks that we purchased over the years here for U.S. consumers. And then Japan and Germany, they shifted production strategies, but of course, they didn't economically collapse as a result of these trade tariffs. And so the purpose of this is to explain that we have had used tariffs in the past. Some moments were more successful than others. Some were catastrophic, and some were very sector specific. Now, what I will say is, with the Trump administration, their recent announcement of tariffs is the largest by far tariff implementation threat, whatever you want to call it, against countries around the world that we've ever seen. The sectors involved, the countries, the relationships, alliances, all of this impacted at once by this announcement. Now, the after effects are, of course, to be seen, but there will be, what I can assure you, very, very busy moments ahead for the Trump administration's trade teams, because they are going to be negotiating, they are going to be dealing with so much work. And of course, this is something that they signed up for, right? They put this deal out on the table. They signed these executive orders. And now their job is to either negotiate deals and somehow eliminate these tariffs or reduce them, defer them, whatever they want to do, because the long-term implementation or the retaliatory effects of these, that's where we start to see serious negative impact, not only to the U.S. economy, but also globally as well. And it could take a very long time to recover from those. So lastly, I'll focus on how will this impact the stock market and the overall economy. So of course, the immediate effects were that the market reacted very negatively to the announcement of these tariffs. After market hours, that's when the Trump administration made this announcement. There is, of course, after hours trading, and we saw the S&P 500 pull back about 4% in after hours trading. Now, before I started recording this video, the S&P had somehow made a little bit of a recovery and was down a little bit under 3% after hours. But, I haven't checked it in the last 30 minutes or so. And so we'll see. Maybe it's back to being down 4% or maybe recovered. So there is going to be a lot of volatility in the markets now, because investors, economists, you name it, everyone is trying to parse through all of this data, trying to parse through all the variables to figure out, well, what sectors are going to be seriously affected? Like, for example, in the beginning, technology, pharmaceuticals, certain sectors are carved out of some of these more stringent tariffs. But then what about other sectors that aren't? And so that is an element that is to be seen. Now, if we look at all those scenarios I gave to you earlier, in every single one of those scenarios, inflation did not worsen. So it's possible that with exclusions, with leaving certain sectors out, with making deals relatively quickly, we may not see the negative impact that are being expected from some economists on the inflation standpoint. But what we did see in all of those scenarios is serious negative GDP impact and serious negative impact to unemployment, which then could cascade into recessions or other very negative economic consequences. And so the key here will be, I believe, that the Trump administration will hopefully work overtime and try and come up with trade deals and get themselves out of these tariffs and announce some sort of a victory, a political win, and ride into the sunset as the midterms come up. Maybe that's why, and maybe that is what their strategy is. And will those deals be great for the United States? Historically, these deals, once they're implemented, everyone's happy, all sides try and take a victory lap, and then the actual compliance of these deals is not very good. But nonetheless, that's how these trade deals have played out historically. From an economic standpoint, again, as I mentioned, it depends on the duration of these tariffs. The longer they're in place, the worse off the economy will be. And so, my viewpoint is that they will be short-lived. And so I believe that within the next 12 months or so, we should have a lot of these trade tariffs reversed. And then the market should have a relatively okay reaction over the next 12 months. I still think that we're headed for a positive year, despite all the negative headwinds. But again, this really relies on the Trump administration actually putting some work in to negotiate some of these deals. I don't think that we're going to move to a system of no income tax. I don't believe that these tariffs are going to be in place for decades to come. Just like how this president put these tariffs on, the next president could take them off. The U.S. Congress could step in and void out some of these tariffs, or change some of the laws that give him the power to put these tariffs in place. And then you also have the World Trade Organization that could step in and remove or get in the way of some of these tariffs as well. And so there are a lot of variables in place here. The initial reaction from the market, somewhat justified, but I believe also somewhat of an overreaction as well. I'm staying confident in what's happening in the market, and I'll be curious to see how this all plays out. But I still have some optimism in me, although it is cautiously optimistic, and I will be paying very close attention to how things play out. But hopefully this video helps you understand what's happening with tariffs and also what investors should be paying attention to. As always, please reach out if you have any questions. Thank you so much for tuning in to this week's episode.